Hey everyone, and welcome. Today, we're going to pull back the curtain on a really powerful tool that a ton of traders have in their toolkit. It's called the Commodity Channel Index, or just CCI for short. At its core, it's all about measuring a stock's momentum. And by the end of this explainer, you'll know exactly how it works and what it's trying to tell you. So, let's start with a question that I guarantee every single person watching has asked themselves. You know that feeling, right? You're looking at a chart, a stock is just rocketing up, and your gut is telling you, wow, that's gone too far, too fast. But how do you actually measure that feeling? How do you know if a stock is genuinely overstretched or if it's just getting started? Well, that exact problem is what the CCI was built to solve.
So, what is this thing? Well, the CCI is what's known as an oscillator. It basically measures how far a stock's current price has strayed from its own average price. I love this analogy. Think of it like a price energy meter. You know, when the price shoots way up, the energy is super high, and when it drops way down, the energy's low. It's all about measuring how far that price is stretched, kind of like a rubber band, from its normal baseline.
And you know, this isn't some brand new idea. The CCI was actually developed way back in 1980 by a guy named Donald Lambert. He originally designed it, as the name suggests, for trading cyclic trends in the commodities market. But over the decades, traders have found it's incredibly effective for pretty much everything. Stocks, ETFs, you name it. Okay, so how in the world does the CCI actually calculate that price energy number we were talking about? Well, the good news is you don't need a PhD in math to get it. It's really just built from 3 key ingredients. Let's break down how this thing is constructed, piece by piece. Here they are, our 3 building blocks. First, we've got to find a fair, balanced price for the day. Then, we need to figure out the recent trend so we have something to compare it against. And finally, we have to measure the stock's normal amount of, let's call it, wobble. So, let's tackle these one by one. First up, our first ingredient is something called the typical price. Now, instead of just using the closing price, which is really just a single snapshot in time, the CCI wants to find a price that's more representative of the entire day's trading action. And the way it does this is beautifully simple. You just take the highest price of the day, the lowest price of the day, and the closing price, add them all up, and divide by 3. That's it. This gives us a much more balanced number that really reflects the whole story of the day. Okay, so now we have our typical price for today. But a price is only high or low in relation to something else, right? That's where our second ingredient comes in. We need a baseline. So the CCI calculates a smoothed average of that typical price, usually over the last 20 days. This gives us a clear picture of the recent trend. And finally, we need some context. Think about it. A $1 price move for a $100 stock is just noise, but a $1 move for a $5 stock, that's a huge deal. That's where our third ingredient, the average deviation, comes in. It measures the typical amount of wobble in the price, telling us what a normal day's move looks like for this specific stock. And this is where the magic happens. Here's how all those pieces fit together. The formula first looks at the difference between today's typical price and its recent average. In plain English, it's asking, how far is today's price from its recent trend? Then, and this is the crucial part, it divides that number by the stock's normal volatility. So it's asking, okay, and how big is that move compared to a normal move? This is what makes the CCI so smart. It measures everything in the context of that stock's unique personality. So after all that, finding the typical price, the average, the deviation, it all gets crunched down into one single number. That number is our CCI value. And it's a powerful little data point that tells a very specific story about the strength and momentum behind the current price move.
All right, so we've built the indicator, we've got our number. Now for the most important part. What does it actually mean? Let's dive into how you actually read the signals that the CCI is giving you.
The whole story of the CCI really revolves around 2 super important levels, plus 100 and minus 100. The creator, Donald Lambert, figured out that for most assets, about 70 to 80% of all the price action happens right there between those 2 lines. So you can think of that area as the normal zone of price behavior.
So what happens when it leaves that zone? Well, when the CCI value pushes up above plus 100, that's a signal that the price is unusually strong, maybe even stretched to the upside. Traders call this a potential overbought condition. And on the flip side, when the CCI drops below minus 100, it's signaling that the price is unusually weak and low, a potential oversold signal. Now this is absolutely crucial. These signals are not a command to immediately buy or sell. Think of them more like an alert, like a yellow flag.
An overbought signal tells a trader, hey, pay attention, this strong uptrend might be running out of gas. They use it to look closer, to confirm what other tools are saying, and maybe to get an early warning that the trend's direction might be about to change.
It's so important, though, to put this tool in the right perspective. As powerful as the CCI is, it's not a magic bullet. It's not going to make you rich overnight. Like any indicator, it has its limits, and it's really just one piece of a much bigger puzzle.
And here's the point I really want to drive home. The CCI is an oscillator, not a fortune teller. Its job is to provide context about momentum, not certainty about the future. For example, in a really powerful uptrend, a stock can stay overbought with the CCI above plus 100 for a very, very long time. So you can't just blindly sell every time it crosses that line. Context is always king.
So, if you remember just one thing from all this, let it be this. The Commodity Channel Index helps you quantify momentum. It takes that gut feeling we talked about, that sense that a stock is overstretched, and it turns it into a real, objective number by comparing the current price to its own unique history and its own normal volatility.
The CCI is a fantastic tool, for sure, but the best traders I know rarely use any single tool in isolation. And that leaves us with a final question to think about. What other tools could you pair with the CCI? Maybe something that measures the overall trend or trading volume. How could you combine them to build an even more complete, more robust picture of what the market is doing?